Okay, we're live. It is Thursday, November 23rd, and we continue to have some great market action. Hey, everyone. If everyone can hear me, please let me know.
It's great to see everyone after we missed everyone last week for being at the wrong time.
Yeah, some timing issues, but all good. So I assume everyone can hear me. Otherwise, they'd be saying, we can't hear you.
I can hear you.
For Def, Andre, Vladimir. Thank you, Vladimir. Thank you. Okay. All right. So we were just sort of chatting before. We're waiting for more people to come into the room. We were just sort of chatting about DVOL and the fact that Thanksgiving weekend is now upon us for the Americans, and that does have some impact, of course, on things. We're trying to think of our strategies for the accounts we trade. We were doing a lot of decision making this morning, which I'll talk a little bit more about later. But we're wary all the time. It seems like news comes out once a week and the market goes a bit crazy up and down. We wanted to be well protected over the weekend because if the Americans aren't if they're on holiday, the market could be very, very thin. And, maybe Asia will wake up and they'll decide to ram it one way or the other without much resistance. So we really want to be protected in the down event of an up or down, 3, 4, 5, 6, 7%, either way. So to make sure we didn't lose any money or perhaps gain. So we had to do a lot of fidgeting and adjusting and fussing with it. But I think we got it things to where we're pretty happy. But it's been great. Vol has come off a little bit in the last day or two, and it's kind of at the low of its range right now on both Bitcoin and Ethereum. The other thing too, and maybe Rich will show this later, but the volatility surface is quite interesting too. So it hasn't changed a lot for Bitcoin. For both Bitcoin and Ethereum, we see there's a big spike of volatility for the on the call side for the Thanksgiving weekend. But the Ethereum volatility surface is actually quite shallow now. It really changed quite quickly. I was a little bit surprised when I jumped on this morning and saw that. So let me just bring up slides here. And Richard, can you turn your screen share off, Richard? Because I think that might screw us up. Because last time we had that weird issue where people couldn't see. I think maybe because we are crossing streams. Ghostbusters reference, by the way. Thank you very much. But before I get started, I do want to mention, if you are not yet a user of Deribit, and you probably are, check out in the chat. You can save 10% on your trading fees. Of course, use our little link there. That's always a good thing. Fees make a big difference on our bottom line at the end of the year. And the other thing too, I'll mention. Well, actually, I'll do that. I'll do that in just a minute here. Let me just go through the slides here. The first slide. What we're going to talk about today. We're going to do our little analysis. We always do all the time. Take a look at some charts. Take a look at what we're thinking, what we got on. But we're going to talk about risk reversals. A lot of people have an idea in their head what risk reversals are. And as with everything with options trading, it seems like there's numerous names for different strategies, and sometimes they vary from person to person. But the way we use risk reversals, or the most common way we use them, is probably quite different from what anybody else does. And we're going to get into that, and that's going to be good stuff. But as always, check us out, roguetrader.academy. Any course you sign up for, any subscription level you sign up for, you get 7 days free trial. And anything silver and above, you get the access to our Telegram channel where we post our live trades, and we have chat in there. We have a call every week, a Monday call, or Ask Me Anything type call. We've also started doing something really cool. Earlier this month, we were asked by our good friends over at ZigDAO to start a fund and to start trading there. And what we do, and we trade this through the Deribit platform, of course. And what we do there is we just started off with a $5,000 account, because that's sort of the average amount a retail trader would use. And we just trade that. So every day we're producing at least one video a day. We sort of sit and talk for 15 to 30 minutes. Richard and I just discuss our strategy. We look at all the metrics. We use immersive finance as our tool for analyzing the metrics of the market. We make our decisions, we make our trades, and it's probably very, very insightful for a lot of people to see how Professional traders trade a fund. So that's a lot of fun. So of course, silver and above get access to that. Okay. So let me first just, I'll stop sharing this maybe. And what I'll do is I'm going to, how do I stop sharing this? I got to go slides. See, more of a professional. All right. Screen share on. Let me show you my silly charts. Now, interesting stuff here. Can you see this chart, Richard? You can see it?
Yeah, I can.
Okay. This is Bitcoin. I've got my unicorn up here. Why do I have my unicorn up here? Because we've got this big bar of resistance. Basically, if we bust above 38, we're going straight to 41. I don't care what anybody says. Unless it's a fake and comes back down, it's going to 41. I can almost guarantee it. Now that I say that, it probably won't. But basically, this is the big resistance area. So if we just bust up through here.
Shane, where does your big magic bar of resistance come from?
This?
Yeah.
As always with charts, look left. If we look left, we'll go back far enough and we're going to see, let me go to a daily chart because I got to look way left now. It stopped here. It came down, stopped here. Came down, stopped here. Went up, stopped there. So we've got all this action kind of in this area. And that's why
the big Bitcoin mean reversion.
Yes, and also tea leaves. So I had this trend line drawn that we kind of started off on a bit of a trend, kind of came close to it. This one didn't come that close, had that huge explosion up, went sideways for a while, slightly up channel, went down, plunged through it, up, plunged through it. But we keep hitting our head up here at 38,000 exactly. Technically, now we're slightly below this little trend line. I wouldn't say the trend's been broken. We could just go sideways for a while. I wouldn't be surprised at all. If this thing busts up above 38,000, we're going. This is going to be a vacuum right here. This will be a vacuum. It'll go right through it. So I'm not going to be selling calls here. I'm probably not going to sell calls of 41. I'll be selling calls of 44. I'll be selling calls of 46, 47, 48, depending on the volatility and how much for sure. Now, if it doesn't, I expect to keep it hit its head off here. Either set trend sideways or we're going to come back down. That's what I think for Bitcoin. Ethereum, well, we've got kind of a similar situation, right? We've got this big bar of resistance up above. So if it gets above this sort of, 2100 area, boom, we're probably going up to 24 toot sweet. And then I'll be looking to sell 27s, 28, whatever, depending on vol and the size of the move. But we're in a sideways channel right now. So we're in a sideways channel. If it busted down through this channel, the maximum we go down would be 16, 1700 area. I'd be very, very comfortable selling put spreads down there. But we've kind of got this sort of a cockeyed, crooked, a bit of a trend line. I wouldn't really lean on it too much, but I'll leave it there for now. Is considering taking it out. But that's what we got going on with the charts and what we're looking at. We are very, I'll say, adamant that we don't want to sell vol much under 60. I think if we're looking at 50 or something, I feel this market. If you watched our show we had with the head of options over there, he was talking about maybe we go to 100 vol. Maybe he's right. We've been there before, so why not? Or certainly, briefly up there. I wouldn't be surprised. We want to make sure that we keep some powder dry. So if we get some stupid volatile event, and it's coming, it's not if it's going to happen, it's when it's going to happen. Mm-hmm. We don't have a lot of losers to manage, and we'll be able to take advantage of selling that. And it's also, if you're going to have a time when you're going to be long gamma, and by that I mean a directional, whether you think it's going up or down, or maybe both, you're putting on long strangles or something, now's the time to do it. Because it seems like every week some piece of news comes out, moves the market 3, 4, or 5%. So, if there was a time to be a long gamma, it'd probably be now. What else can I talk about? Let me go back to the slides. Or Richard, is there anything you want to share before we go in? Or maybe should we, if there's anything you want to share that doesn't have to do with our presentation, maybe we'll do that now. Then I'll go through some of our risk reversal stuff.
Yeah, no, actually, I think the current vol situation feeds well into our risk reversal story. So, okay. I think my update is that we see massive skew to the upside. We see quite high funding rates at the moment, even though the market isn't moving. It kind of all smacks of people expecting upside. Now, bear in mind it is Thanksgiving Thursday, so nobody's going to be trading in the States other than people looking to take advantage of thin markets. Then they've got a half day tomorrow. So this whole weekend is kind of a weekend. And normally on a weekend you'd see vols get crushed because no one's around. But actually we've seen vols sticky, and it's frustrating for a vol seller because it means you can't book a P&L, and it kind of makes you a bit nervous. So in fact, this morning we took off. We actually wrote a short call last night on our Zigdow book, and this morning we rethought it and took it off, got just rid of it because we weren't comfortable.
That's right. And luckily we have the tools from Immersive, so we can see the vol shock, we can see the price movement, and we thought, you know what, if the price goes up, this thing's going to cause us a big pain in the butt. We just felt that it wasn't worth running that risk because we're just too close to the strike price. But yeah,
that was actually an overnight. That's expiring tomorrow, 38,000 call, which is probably a no-brainer, right? But it was actually causing me to not lose sleep, but to think too much about it. And in my experience, if you're thinking about a position too much, it's just get rid of it. You've got a life to live. Right?
And there's the old adage: if you didn't have the position, would you put that on right now? We both said no. We probably wouldn't put that on right now.
No chance. And so we paid 5 basis points just to get rid of it.
All right. Let me just, I'm going to run through some slides here, and we're going to talk about risk reversals. Now, a lot of you might know about risk reversals. As I mentioned, there's often different terms used, or people use things in different ways, but I'll go through the most common ways, and then we'll talk about ours. So also known as protective collars, depending what school of options you happen to go through. And they're typically used to protect or hedge an underlying options position, where one option is bought and another is sold. It can be done as a total debit or a credit. We do both. It just depends on the situation. Now, let's just say you are short an underlying asset, whether that's crypto or stock, doesn't matter. We can hedge with a long risk reversal. You buy a risk reversal. That's buying the call option and then simultaneously writing or selling a put option, okay? So if that underlying goes up, remember, you're short, and it goes against, it goes up. The increasing value of that long call is going to offset the loss of the short underlying position. If the underlying drops, the short underlying position will appreciate, but only down to the short put strike price. Fairly basic stuff. Now, if you were long an underlying asset, we just reverse that. You can hedge with a short or selling a risk reversal, and that's buying a put option, okay, or simultaneously writing a call option when you do that. So if the underlying goes down, goes against your underlying position, the increasing value of that long put is going to offset the loss of the long underlying position. If the underlying rises, the long underlying position will appreciate, but only up to the short call strike price. Okay. So the other instance where you can do this, and this is a very popular strategy for people who trade equities and stocks, where they're looking to get exercised, where they're selling a cash secured put. So and they're kind of not necessarily hoping, but they're okay if that put gets exercised and they take a position of the stock because they're getting it at a lower price than what it currently has. So where that investor runs a bit of a risk is that they really want that stock, but the price doesn't go down and they don't get exercised on the short puts. Yes, they make some money. They collected some premium from the short put, but they missed out on the stock going up. So when they sell that cash secured put, simultaneously using some of that cash you got to buy an out of the money call with the same expiry. So that's traders who want to accumulate shares by selling puts, but they still want to retain some upside potential if that stock rallies. That's another place where people use risk reversals. One other one is where you're buying and selling the same strike and expiry. So the exact same, it's $100 or $2,500, whatever it happens to be. And this is normally done only for a credit. And that payoff diagram would just be a straight line, a horizontal line of that credit you receive. Okay, it takes advantage of some arbitrage opportunities reflected in the options pricing skew. So options are often open at the price of stock ownership. So when they buy the stock, they'll often layer that strategy on right away if there's a skew there. And then at expiry, when those options expire, only one of the two options is going to expire in the money, and the other one's going to be worthless and out of the money. So that in the money option will automatically be exercised and then close out the stock position. So not quite as applicable to crypto. typically, but that's you'll come across this jargon. So let's just sort of talk about how we're using it, and we use it with futures. And Richard's going to go into detail on this. So, for example, if we're selling a risky, so we're selling a call and we're buying a put. So if we're selling, we're just thinking we're going down. If we're buying a reversal, we're thinking up. Okay, so if we're selling a call and buying a put with those proceeds, we sell the call, we use that cash to buy a put. Not normally at the same strikes, though, okay? We're away from the underlying price. We've got some wings out there. We do it in conjunction with being long a futures contract. Now, remember on Deribit, we're already long the underlying anyways in order to trade, right? So what we're doing is we're trying to capture the skew, the spread in the premium between the calls and the puts with the same options, with the same delta. So remember, you're looking at a 20 delta call, 20 delta put, okay? So in that volatility service, so taking advantage, capture the skew in the volatility service. And then what we do is we instantly hedge it with the future. So we're locking in any gain we get there. As long as the cost of carrying those futures doesn't outweigh the spread value. Okay, so I hope that was relatively clear as mud. But the Richard can go a little bit deeper into this, and we've got the tools we use with Immersive are super good on identifying these right away.
Yeah, sure. So let me call up. I mean, actually, the current market is a great example. So here you see on the right-hand side, I'm showing the constant maturity volatility surface. So a constant maturity volatility surface is where you're not showing exchange expiries, but you're approximating and interpolating between exchange expiries to fix it 1 week, 2 week, 1 month, 3 months, etc. And it just gives you a way to get a feel of the shape of the vol surface without having to worry about the minutiae. And then we express the vol surface in terms of the at-the-money forward, which is the vol of the at-the-money with respect to the synthetic future of the expiry. The 25 delta fly is the difference between the in this case, how much more vol is in the 25 delta calls and puts above the at-the-money calls and puts. And the 25 delta risk reversal is how much more vol is in the calls compared to the puts. So in this case, what we can see is at 1 week, at-the-money forward, it's 47.67%. However, the 25 delta strangle or butterfly is 2.42% vol higher. So that's more like 50 vol. And the skew is that the 25 delta calls are 7.6 vols higher than the 25 delta puts. Now, if we look at if we look at that, actually the 1 month is the same. So we can actually then go and look at that on the actual market. You can just go in here and find the 1 month, which is pretty much 29th of December. There's a whole bunch of positions here. Ignore those. If we look at the 25 delta, so here's 23 delta calls. You see that they're at 43,000. So that's 14% away from the money, and they're trading at 255 basis points. If we then go and find the 25 delta puts, here's somewhere between 20 and 26, then we're trading at probably about 220 basis points. So it's kind of an average between these two. So the 25 delta calls are trading at about 35 basis points higher than the 25 delta puts. And similarly, those puts are actually closer. So they're at about 10.5% away from the money, whereas the calls are, what did I say, 14% away from the money.
Yeah.
So if you were to sell the 25 delta risk reversal, what you're actually doing is selling, in this case, more or less the 43,000 call and buying the, what did I say it was?
33 or so. Or
yeah, 33 or 34. Maybe you buy one of each of the 33 and 34,000, half of each of that. And then, of course, that would give you, because it's 25 delta, if you did 1 Bitcoin of it, you've now got a delta of 25, minus 25 from the short calls and minus 25 from the long puts, so you've actually got a delta of a half. So you would actually then go and buy one half of a future, one half of Bitcoin of a future. And so there's a couple of things going on here. So first of all, you've bought the future and you sold the calls at a premium to the puts. So if the market doesn't move and it all expires worthless, you're going to pick up that premium. If the market does move gently and you keep on adjusting the hedge of your delta hedge and sustain it zero delta, as long as the cost of that movement of the hedge isn't too high, you will spend less on the hedge than you'll make on the skew, so you'll end up in profit. And also, there's the dynamic that the market can move further up than down, and even though you're short gamma on the upside, you've got plenty of time to get your hedge in. So there's every opportunity to make money on hedging the smile as you're actually hedging that short gamma on the upside. So there's kind of three ways to make money out of that, just because there was a skew in the vol surface. Now, of course, it's worth mentioning that if that skew in the vol surface is reasonable, if we believe that the ETFs are about to be launched and everyone's going to pile money in, then arguably it is. Then you may not want to go selling the risk reversal just yet until it's higher, because like any spread, I'll go back to this tab. Like any spread, the risk reversal number will change. If I graph this, see on the see blue, I'll do it in color. There we go, green. So we see how the ratio between the puts and the calls changes over time. Ignore that, that's just an anomaly in the data. But you see how between 1500 yesterday and 2100, the risk reversal went from 8.5% up to 13%. So if you had been short the risk reversal, just in the same way as it is being short a basis spread, if the spread widens, then obviously you're going to show a negative P&L. And if the spread narrows, then you're going to show a positive one. So you kind of arguably, probably the risk reversals are high because there is expectation of shenanigans over Thanksgiving weekend. And if there are going to be shenanigans, the likelihood is probably up, is an easier path than down, if the thesis holds. And so you can argue that market makers are prepared to mark calls higher than puts. And if all of that turns out to be nothing, then of course it would have been a great trade to sell the calls and buy the puts, and do the hedge, because you can just pick up as that reverts. And these risk reversals go from, I've seen them minus 20% to plus 20% or more. A normal market, you might see them maybe like 2 or 3%, maybe 5%. So in the same way as you can trade any spread, you can trade this spread, and it's quite a nice trade. We can make quite a bit of money out of doing this in Bitcoin.
Yeah, I think we use risk reversals in different capacities quite frequently. That's why I wanted to talk about it, because a lot of times we talk about that with people and they're like, what? Hang on, what do you mean? What's a risk reversal? And another way too, if you don't want to get quite so in depth, a lot of times if an asset is going up and it rams up and it hits its head on some kind of resistance, or you expect it to, well, we're always sort of selling calls at a bit higher because we expect things to get stalled there. Even if it does continue up, it's not going to go straight up. It'll give you some time. The time decay will come off. That's a great time to sell a risk reversal, just simply because you expect the price to probably reverse or come down a little bit, but it's a little bit more aggressive than just selling a call or a call spread. You sell a call spread, all you're going to do is you make, the maximum will be 100% of the premium will be the maximum you could make on that trade. But you're sort of using that premium to say, okay, I think we're going to have, might retrace 20% or 50% or, whatever you happen to think. So you get some long puts in there. So it's a little bit getting closer to a Texas hedge, a little bit more riding on it. And that's when Richard jumps in and says, well, hang on. This is when we lock in with futures. And that's how the idea got introduced to me. Is then we started I started gearing my head to say, okay, you know what? Instead of looking to just keep it as a basic risk. There's nothing wrong with a basic risk reversal. He put that little bit extra layer on there to lock in that difference, that spread in the skew, which I think is
it's very, very similar to when you're selling the dated future and buying the put to try and take advantage of the basis spread between the two.
All right, we got a few questions here, and thanks, Vladimir. You said you watched all our videos on YouTube and you like it. That's great, thank you. Core did mention, I guess, when I was showing my charts, he said 42K. When I was talking about 42K in Bitcoin, is the top of the weekly Ichimoku cloud. Now we don't want to get into Ichimokus, or we're not doing, anything crazy with our charts. We're just drawing some simple lines because we don't want to get too deep into technical. But that's good to know. That's good to know. It's up there. So Andre was asking earlier when I said we're not really selling anything below 60 or not much below 60. He says, why not 50? Why not 70?
It's pretty simple. So yesterday I wanted to sell a two-day call to pick up some premium, and the 38,000 call was priced at about 29 bips. And I thought, do I really want to be selling $1,000 away from when we've been up here already for 29 bips? And so I put the order in for, I don't know, 50 bips.
50, I think.
Which is equivalent to pricing that option at, I think it was like 55 vol, which for a 2-day option is actually quite high. And I just put that order in, thinking, you know what, if vols go up, and I'll get that, and I'll be able to capitalize on the decay. Well, what actually happened was that vols went up to about 60, and I got filled at 50, and then the price went up to 65, and the market was of course moving up, and so now we were at 37,500, $500 away from my strike, and here I am sitting on, well, I only took 50 bips for it, and I actually started feeling very nervous about it. And this all happened basically because I sold that option too cheap. And what I should have done was sold the 39, put an order in for the 39,000 at 50 bips. And that would have been a whole lot more comfortable. And I'd have just sat there and written it out and said, there's no way it's getting to 59. And I'd have made myself an extra $200 for 2 days work.
And I suppose something I'll mention there too is it really depends on the range. So in the summer, selling 60 vol would have been a dream come true. Vols were hanging around the 30 area, and we weren't selling. I can't remember if we're selling less. We wouldn't selling less than 40 or 50, whatever.
45, yeah.
But last year, we probably wouldn't be selling anything less than maybe an 80.
90, yeah.
So it just kind of depends. You want to make sure you're always sort of selling at the upper limits of the current range to give yourself the most opportunities possible.
Yeah, actually, we can quickly look at the screen share of the Deribit.
We're almost out of time, so we'll
Oh, sorry, man. Okay.
Yeah, no. It's okay. If you want to screen share, we can probably get a couple of questions.
No, I was just going to look at the devol, and you know what? Because 60 vol is kind of near the top of the current range, and if vols are at 55, then if you just write them and leave them overnight and go to bed or go to sleep while the Americans are trading, someone's going to probably drive vols up to 60, right? So you may as well just put the order in at 60. And if you don't get filled, well, you can always try again tomorrow. And if you do get filled, then at least you got filled at a price that you're happy about, rather than sweating because you sold it too cheap. Yeah.
No, I agree. So Stanislav saying, I don't understand the difference between the 30 RR risk reversal and the 30 fly. His English is great, no problem. For example, the 30 risk reversal plus 2.5%. Does this mean the calls are more expensive than the puts by 2.5%?
Yes, it means that the implied volatility of the 25 delta call or 30 delta call. What did I say? 30. It's a 30 RR. Yeah, the 30 delta call has been priced with 2.5% more implied volatility than the 30 delta put. And with the 30 fly or 30 butterfly or 30 strangle, it's also called, you're looking at the average implied volatility of the 30 delta call and put is, in this case, 2.5% higher than the volatility of the at the money call and put. And so what you're describing with the butterfly is the curvature of the vol surface as you travel away from the money. And what you're describing with the risk reversal is how skewed that curvature is. And it's just a way of expressing the numbers. You could also express the numbers as the 30 delta call is this, the 20 delta call is this, the 30 delta put is this vol, and so on. And you could then infer the risk reversals and the butterflies. But the butterflies and risk reversals just give you a mental picture very quickly of the shape of the vol surface without having to go and draw a picture.
Exactly. A question from Stan: do you dollar cost average when selling options? Yes, quite often.
Yeah, we like to scale in. If there's a massive move in it and we don't believe it, sure, we'll pile in if we've got some spare gunpowder. But if you're not sure and you're running a wave, you don't want to go all in, right? Ever. You want to always keep some powder dry.
Yep. Question from Linus. We only got a couple minutes here. We'll get these last two done. Do you trade Deribit's devol futures? If yes, any interesting ideas on structuring options and futures?
Well, I didn't realize you could trade them yet.
Neither did I. I was hoping you knew because I just saw that question. I'm like,
I know they're going to bring them out. So they've done the devol index, and then they're going to do futures on that index. Yeah. So trading a volatility futures index is exactly the same as trading the underlying, as long as you have delta hedging. Trading the underlying options. If you want to be long the devol, then you basically buy the correct ratio of each strike of calls and puts, and then delta hedge with futures. And if you want to be short the devol, you would sell the correct ratios of each strike of calls and puts, and you would delta hedge constantly, and that would give you the same payoff.
Products are so nice.
Yeah.
Because you can either buy or sell.
yeah. I mean, so it's basically it's a shorthand for doing all of that. But of course, you can guarantee that the guys buying and selling the devol futures to and from you are going to build in a spread to make it worthwhile bothering. So you're probably going to end up paying more for your vol than you would otherwise if you just traded the underlying, but it's much easier.
All right. Last question of the day. We're past our time. So Vladimir is asking, how would you suggest to hedge by futures risk reversal spreads to fix the skew difference? For example, if someone sold one Bitcoin call, sold 1 point, so you'd be buying a call and buying a put, not selling both. What the amount of futures should be bought or sold to hedge in that case?
So this is going to depend on what the relative deltas are of those two positions. So you're basically buying, let's say the difference is 0.05 Bitcoin of delta, then you would sell 0.05 Bitcoins of futures to hedge that off.
And ideally, you'd have to hedge it as the price moved as well.
You definitely need to, because as the price moves towards your calls, your short calls, for example, then you're getting offside. Yeah. Cool.
Fantastic. Let's wrap it up. Again, thank you everyone for joining us. Lots of great questions. Love having you guys. Sorry, just before we go, Linus says here they are, USDC margin. He put a link in the chat there. We'll check that out later for sure, Linus. Sometimes we miss new products coming out.
Yeah, there is a market there. Yeah, for sure.
Yeah, very cool. Again, hey, if you want to join us and chat with us during the day, go over to roguetrader.academy. Any subscription, silver or higher, and you can hang out with us on Telegram, join us for the weekly call, and have access to our daily trading videos where we trade fund on ZigDAO. Great platform to check out. Everything is done through Deribit, the premier options trading platform in the world. So, plugged everyone. I hope everyone's happy. We're going to talk to you all next week, and I expect after this Thanksgiving weekend, we may have some fireworks. So, I think we'll have a whole new scenario in front of us next Thursday. Thanks for joining us, everyone, and we'll see you next week.